Today, I want to talk about a strategy that often goes overlooked or is even unknown to many investors. If you've been following the markets lately, you probably feel like things are a little expensive. Stocks aren't exactly cheap by historical standards. Hitting all time highs is normal and it's healthy in and of itself, but the price of stocks, when compared with estimated earnings, is high. This can go on for years at a time, so it's not a figure that we can use to try to time the market. But the question many investors have today is, especially if they have new money to invest, how do I participate in market growth without taking on the full roller coaster ride of stocks? Well, today I want to introduce you to convertible bonds, a hybrid strategy that can give you a middle ground, a way to potentially capture upside without exposing yourself fully to stock volatility. And don't worry, we'll keep this simple and practical. So, what exactly is a convertible bond? Think of this as a cross between a traditional bond and a stock option. Here's how it works: it's issued by a company just like a regular bond. It pays interest, usually called a coupon, on a fixed schedule, same as a normal bond. At any point before it matures, the investor can choose to exchange it for a set number of shares in the company. So the key idea is this: if the stock doesn't do well, you still collect your interest. If the stock value takes off to the upside, you have the option to convert your bond into shares and enjoy some of that upside. It's like having a safety net while still keeping the door open for growth. Let's make it a concrete example. Imagine you buy a convertible bond and it has a par value of $1,000. That's what you loan out. Let's say the maturity is 3 years from now. The coupon rate is 4% annually. The conversion ratio, let's say that's 20 shares per bond, and the current stock price is $45. If you hold it to maturity without converting, you'd earn $40 per year in interest. Now let's look at two scenarios. What if the stock jumps $60 in 2 years? Your 20 shares would be worth $1,200. So you could convert and gain 20%. Plus, you've already earned interest and you get to keep that as well. What about the downside? If the stock drops to $30, your 20 shares would now only be worth $600 if you converted. But no worries, you can just hold the bond, keep collecting interest, and get your $1,000 back at maturity as long as the company remains solvent. So the convertible bond gives you a way to capture upside without being fully exposed to downside risk. Now you might be wondering, why would a moderate risk investor consider these right now? Well, as always, I don't have to state the obvious, but markets are unpredictable. From today's heights, the next 12 to 18 months could end in a wide range. But what I personally believe would be healthy growth would be single digit upside. Though with optimism, it could go easily well beyond that. Alternatively, of course, markets could drop. Even the experts can't say with strong certainty. Here's how the convertible bonds can help. If markets drop, they usually hold value better than stocks. If markets rise, you may capture part of that upside if stock prices rise high enough. If markets stay flat or they rise moderately, you still collect steady interest, but don't get the stock market upside. Remember, these outcomes are illustrative. They're not predictions. The point is to provide a middle path option for a portfolio. Now, of course, as with anything, there are trade-offs. Convertible bonds usually pay a little bit lower interest than a traditional bond of the same maturity because of the built-in conversion option. There's still interest rate risk, which means bond prices can fall in the short term if rates rise. There's also credit risk, meaning if the company defaults, both the bond and the stock can lose value. For investment grade issuers and shorter maturities, these risks are generally lower, but it's important to understand them. Buying individual convertible bonds can be complicated for beginners, but a simpler way to get exposure is through the convertible bond ETFs. ETFs automatically diversify you across multiple companies. They also present you with higher liquidity, meaning you can easily sell them for their share price whenever markets are open, and there will usually be a buyer that's ready. A big difference is that, unlike individual bonds, ETFs don't have maturity dates. Rather, they have duration periods. Choosing a shorter duration, like 1 to 3 years, can help reduce interest rate risk while not giving up significant interest, especially considering today's U-shaped yield curve. ETFs offer a way to dip your toes without diving headfirst, especially if you're cautious about market timing. So here's the takeaway. Convertible bonds let you rest easier than if you were 100% in stocks, keep more upside potential than a plain vanilla bond portfolio. Position your portfolio for an unpredictable next 18 months without fully committing to a risk on or risk off approach. They're a middle path, a hybrid strategy for investors who want some growth but also want to cushion against uncertainty. If you're curious, do more research and talk with a licensed advisor to see if it fits your comfort level and goals. Remember, this is not financial advice, it's not investment advice. This is simply education, helping you understand what strategies are out there. All right, friends, that's your quick guide to convertible bonds. If you found this helpful, hit the like button for me, subscribe for more practical investing insights, and share this with a friend who's trying to navigate these tricky markets. I hope this gave you a practical idea to consider as you navigate these markets. And remember, investing is a journey. Take your time, keep learning, and focus on strategies that fit both your comfort level and your long-term goals. I'll see you in the next video.